In a nutshell, here are the most important tax benefits for real estate investors. Deductions. This is one of the biggest real estate tax benefits that are available for investors. These tax write-offs, which are often applicable for rental properties, will include costs that have to do with mortgage interest, property tax, operating expenses, depreciation, and repairs. 1031 exchanges. If you are a real estate investor, you can use a tool in the tax code that they call as a 1031 exchange. This tool lets you defer any profits that you make on the sale of your real property if you purchase another similar property of equal or higher value. Capital gains. Investors should pay capital gains tax on the real estate investment property if they don't reinvest the profit they realized on the sale. This also applies if they don't offset it with other losses. Capital gains on a rental property that you sell could go as high as 20% of the profit that you realize, depending on your tax bracket. But as long as you own the property, you don't have to pay capital gains tax. However, when you sell a real estate investment property for a profit, that's the time you have to give the government its share. Depreciation. Another huge tax break that's available to real properties is depreciation. Through this provision, you can recover the cost of an income-producing property via yearly tax deductions. The IRS defines depreciation deduction as an allowance for exhaustion or wear and tear. There are three factors that decide how much an investor can deduct each year in depreciation. They are the value of the property. How much is the property worth? The recovery period for the property. How long is its estimated useful life? The depreciation method they are using to account for it. Are you using the straight line method or another method? Appreciation. When you decide to buy and hold an investment property for a longer period, your net worth could grow with you having to pay taxes on the increase. When you sell any piece of real estate, it exposes you to a lot of expenses, transaction fees, commissions, and taxes. You can avoid paying these expenses and taxes while letting your real estate appreciate. FICA. For passive income investors, your rental income is not subject to Social Security and Medicare taxes, aka FICA. Here. When you watch some TV shows, you might think that flipping properties in a matter of weeks is a glamorous and rewarding thing to do, but in reality, a large portion of your profits will go straight to the IRS. The way to lessen the tax component is to hold a property for more than a year. The IRS considers any investment property as capital gains, and they will tax you based on your income and how long you've owned the property. If you hold an asset for less than 12 months, the IRS will apply the income tax rate, which can run up to as high as 35%. However, if you keep a property for more than a year, only the long-term capital gains taxes will apply, and this normally just reaches a maximum of 15%. Let's look at two scenarios. In the first one, you earn $100,000 in a year, but $40,000 of this comes from short-term investments. In the second one, you earn $100,000, but $40,000 comes from long-term investments. This is how it would play out. Scenario 1 with short-term investments. Income tax computation will be $100,000 times 28%. The federal tax due will be $28,000. Scenario 2 with long-term investments. Income tax computation will be $60,000 times 0.28 plus $40,000 times 0.15. The federal tax due will be $22,800. You see, waiting for at least a year increases the amount of your take-home income by $5,300. That's a no-brainer in our humble opinion. Knowing the pros and cons of being a business is essential for real estate investors. If you wrapped up several real estate transactions in a year, the IRS might consider them business or trade rather than an investment strategy, so prepare yourself. While they treat everything on a case-to-case basis, if you're earning more than half of your total income from real estate, your earnings will change from capital gains to a means of producing regular income. This classification will subject you to ordinary income tax rates, which are usually higher. Also, you should pay an additional 15.3% in taxes for being self-employed. Not many people know that deductions are big real estate tax benefits that investors can turn to. These tax write-offs that are often related to rental properties include costs that come with mortgage interest, property tax, operating expenses, professional fees, depreciation, travel and car expenses, and repairs. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Which of the strategies work better for you? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel